Hey Bowtie Nation, Joseph Hogue here. Thank you for joining us for another Monday market update, 9 a.m. Eastern every Monday morning. Get you ready for the week. Stocks to watch, economic news to follow. The news for MPW, Medical Properties Trust, has not been good over the last couple of years. And while most news is automatically priced into a stock, the news is reported, the collective market, millions of investors push the price of that stock up or down and to the point of its new value. Every once in a while, you find something new, news that relates to a company that nobody's seen it yet. A news thread that if you pull on it, leads to a stock upside that nobody has priced in yet. That's where the opportunities are, and that's one that I found in shares of Medical Properties Trust, ticker MPW. I'm going to talk to you in this video. Stick around after that. We'll talk about the stocks I'm watching this week and the economic news you need to see. First though, don't miss this Black Friday discount on my stock trading and technical analysis course. Save 50% off the regular price. This complete course includes more than 30 videos on how professional investors trade stocks and the technical analysis they use. You'll also get the bonus material on fundamental analysis, trade examples, and trading worksheets to follow your trades. Click through the link I'll leave in the description, check out the free preview, and try it risk-free for 30 days. You'll learn how to find stock trades and never run out of ideas, how to identify price changes before they happen, and the top trading patterns used by professional traders. That Black Friday 50% coupon is only good for the next 2 days and the first 40 students though, so check out that link below. Back to our main topic though, and the news has been anything but good for Medical Properties Trust over more than a year. The nation's largest hospital property owner with over 440 properties has lost 67% of its value just this year and was forced to cut the dividend in half. It's still a solid dividend yield even for those of us that bought in at higher prices, but it's still painful. I have just under 5,000 shares at a cost basis of $9.27, and even though I've offset some of that loss with over $6,000 in dividends and $1,200 in a covered call position, I'm still down about 35% overall. Plus, some good news has just been reported through Bloomberg, but the market hasn't put 2 and 2 together yet. Bloomberg is reporting that hospitals are returning to the muni bond market. You can see municipal bond sales for hospital issuers dropped off a cliff after the pandemic, and especially this year. And that return of the municipal bond market by hospitals borrowing money to fund their projects, that's important because it signals better operational performance by the hospitals. In fact, analyst at Moody's upgraded his outlook for hospitals to stable earlier this month on that news. You see, the hospitals, more than most other businesses, were slammed during the pandemic. That's what most people don't understand. Not just from the millions of COVID cases, but from surging wages tied to staff overwork, having to put those higher profit elective surgeries and elective procedures on hold to make room for those COVID patients. Since then, government and insurance reimbursements just haven't kept up with inflation. They're usually tied to a set rate increase each year, and that hasn't kept up with inflation. Nursing shortage has kept wages moving higher. All this together has led to hospital bankruptcies and many pulling out of rural communities altogether. I'm not going to let management at MPW off the hook entirely. They've continued to double down on their largest and weakest tenants when they should have just cut bait and run. It's why while other healthcare REITs like Physicians Realties and HealthPeak have also plunged, MPW has underperformed by a wide margin over the last couple of years. But now that reopening of the municipal bond market is signaling improving operational performance by the hospitals. The fact that hospitals and bond investors feel confident enough in that future profitability to issue debt is just a preview of what we could start seeing over this next year. Anecdotally, my wife is a nurse, and whereas just a year ago the hospitals were begging nurses to take on more shifts, take on extra shifts, no matter how much they had to pay them for overtime, the other night she actually got pushed for a shift, meaning that the hospital had more staff than it needed, so she had to wait until 11 o'clock at night to see if they actually still needed her for a night shift. It's also no longer contracting with those expensive travel nurses or temp agencies, a sign that those wage pressures for hospitals should be coming down. In that same reporting, the head of fixed income at Aberdeen turned bullish on the hospital sector, citing easing wages and staffing issues, higher profit margins, and that rebounding patient volumes. And of course, that brings us back to Medical Properties Trust, which owns the properties on which these hospitals operate. It doesn't mean MPW's biggest tenants are out of the woods just yet, but rent collections will improve, and as this year it's looked darkest before the dawn, over the next few months we could start seeing that daybreak. Now, beyond this good news for the industry and for MPW, it's still really an interest rate story. Real estate stocks got crushed last year, falling 25% and are down another 8% this year. Higher interest rates hit real estate not just through higher interest expense and lower property values, but also through profitability. So the Fed's fastest rate hike in over 40 years was like a 3-hit combo that laid out real estate stocks. That's about to change though. The CME FedWatch tool showing market expectations for Fed interest rates based on the futures pricing shows the odds of another rate hike at just under 10% through the January meeting. Now, those odds of another rate hike were as high as 35% just a month ago, but those inflation expectations and the economic data has changed. Now it's just 10% odds that the Fed raises rates through the January meeting. And by that June meeting shown here, the market now puts better than 74% odds that the Fed has cut rates at least once, up from 58% last month. And I think those rate cuts start as early as the May meeting. When that happens, when the Fed starts cutting interest rates, it's going to be the all clear sign for real estate. You're going to see hedge funds and private equity players scrambling over themselves to buy up all that distressed property. We've already seen how a lot of these private equity players, the hedge funds, have built up war chests of hundreds of millions of dollars to go in and buy up that property. You're going to see valuations improve and banks will start lending again. That's the underlying reason why I believe real estate stocks like MPW are going to be some of your best investments next year. MPW prepaid its 2023 and 2024 debt maturities earlier this year and talked about liquidity transactions available to repay those 2025 maturities in its recent earnings report. Now, this means selling properties, and while real estate companies never want to be forced to sell their properties to finance debt, MPW has over 440 properties with a combined $19 billion in asset value. Lower interest rates next year, along with that stronger hospital performance, will support these property values, allowing the company to pay off or refinance a lot of its near-term debt. And that's really the big overhang on shares of MPW. I'm not going to pussyfoot around that or sugarcoat it. That combined $4 billion in debt that's due over 2025 and 2026. The market is skeptical whether they can refinance that or refinance that at reasonable rates. The company has announced an agreement to sell approximately 1% of its assets early next year, though, which should open up approximately $190 million. Plus, it's got that $350 million in balance sheet cash already. Brings up to about $500 million. Funds from operations here, that FFO measure, is approximately $900 million, and I expect we're going to hear more additional property sales through this year to pay off that debt along with some refinancing. That should take it out of the woods, at least for 2025, make a good head start into 2026. Now, when this happens, we're going to see a repeat of what happened earlier this year when the shares rallied 45% in just 2 months as those short sellers were forced to cover their positions. More than 30% of the shares are borrowed to sell short now, and with 78% held by institutional investors, any sustained good news could lead to a short squeeze. Here we see in this NAREIT data, National Association of REITs, we see that FFO is expected to drop slightly to $1.49 per share next year. This is the only hospital REIT expected to post negative growth, but I think they're going to be positive this year, especially on the turn in that hospital profitability. MPW surely deserves a lower price to FFO valuation than its peers here just because of its performance, but nothing like that 3.5 times FFO per share that we see here. When the average of the group is closer to 11 times on an FFO basis for that valuation, MPW is trading at a 68% discount. Even a rebound to 5 times valuation on any good news would be a 42% pop in these shares and accompanied by a short squeeze. I'm going to turn it over to some of the stocks I'm watching this week. First up, Walmart Inc., here ticker WMT, and other stocks of retailers could come under pressure if those initial reports of Black Friday sales show that slowing consumer. Now, we haven't seen that yet. Earlier reports are that those Black Fridays and online sales have been very good. We're going to have to wait to see what happens on Cyber Monday here. Even more so than in recent years, though, many stores shifted more of their deals online, which likely lowered that Friday and weekend sales volume. We'll have to see how that plays out. Also, anecdotally, there just didn't seem to be the same enthusiasm for deals as there has been in the past. On the upside, though, Snowflake, ticker SNOW, is expected to report 45% growth to 16 cents per share when it reports its earnings on Wednesday. Full-year earnings are expected to nearly triple to 70 cents a share on 33% sales growth to $2.75 billion for the year. Now, I highlighted Snow in a video last month as one of the few names that is actually benefiting from higher interest rates, earning more money on its cash reserves, and possibly setting that up for a surprise earnings announcement. I also highlighted in that same video Arista Networks, which jumped 14% the following week on its surprise earnings as it reported so much in more earnings on that interest expense. And big news in Walgreens Boots Alliance, ticker WBA. It transferred its pension liabilities for the Boots pharmacy chain to a financial services company late last week. And the move is expected to open the door to a sale of the company or just a partial sale of that Boots segment. The company has come under pressure over the last few years and tried previously to sell the British pharmacy chain, that Boots, but bidders were just hesitant because of that pension liability, how much they would have to pay out in the future. Shares were only up about 0.77% on the news of the sale Friday, so the market's still unsure of this outcome, but any divestiture of that segment or just a sale of the entire company could see a price increase that's, I think, is worth the risk. Showing you the bigger picture with that sectorspiders.com sector tracker, great free tool to show you the stock sectors in the market. All 11 stock sectors did close higher last week, but with some surprising evenness in the game that's important. I'm going to tell you why here. Besides stocks in the healthcare sector, which jumped 2.25% last week, all the other sectors really closed very close to that average gain for the market. Now, that just confirms the idea that while investor sentiment is positive and supporting stocks in an upward market, but it's getting strained without any new catalyst to push stocks to new highs. In this environment, until we see some broader economic reasons to send the stock market higher, like inflation or like economic reports, investors need to do more research into individual stocks to find the ones with their own catalysts and the valuation drivers to outperform, because the market isn't going to be doing much of the lifting for them. If we dig into the healthcare sector, we can see some really interesting trends over the last week. The shares of medical device companies have been rebounding from that sell-off this year related to the weight loss drugs. I'm preparing a full video on this topic, but names like Insulet, Abbott Labs, Dexcom, and Medtronic all started to rally after that fear the Wegovy and Ozempic will destroy their demand actually meets reality. Not only is the efficacy and patient retention less than originally thought for these new miracle weight loss cures, but it's at best going to dent the demand for medical devices and some of those obesity-related healthcares. So we can see that Insulet here, PODD, itself jumped 8% last week. Dexcom, DXCM jumped some 7.6%. We also see Medtronic, the largest medical device maker here, MDT, jumped 5.6% in the week. The Personal Consumption Expenditures Index, that PCE report, is going to set the tone for this week when it's reported on Wednesday, following the CPI report earlier this month that showed inflation is coming down. The PCE report is expected to show core price inflation fell to a pace of about 3.5% on a year-over-year basis. That would be versus the 3.7% reported in the month before. Anything less than this as expected, so 3.5% or lower, probably going to threaten that market rally. Fortunately, there's really little reason to believe that this report should come in anything other than consensus or even a little bit lower, so that should support the stock rally from here. Don't miss that Black Friday 50% discount on our stock trading and technical analysis course. More than 30 videos on how to use technical analysis in your investing, all with the link below. Or click on the video to the right to see the 7 top stocks with serious red flags, financial warning signs you need to see. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.